So welcome to the fifth of a series of 5 investment webinars that I've put together for you to take you along the path of learning all about the different facets of buying investment real estate and protecting your asset and growing wealth. For today's agenda, I'll recap sessions 1 through 4, which you can go back to stacylovesrealestate.com and watch the 60-minute version or the 30-minute version on my YouTube channel. And then tonight I'll talk to you about 1031 tax-deferred exchanges and tax abatements. And then Carl Fisher from Camaplan is going to talk to you about a unique opportunity to use your IRA to buy real estate. When I learned this was possible, it just blew my mind. So I'm really excited to share this information with you. And then as always, I will have announcements at the end. So in session 1, again, go to stacylovesrealestate.com. We talked about what are you saving for? Like anything, it's really important to have an end goal in mind, because sometimes you have to take some steps that feel painful along the way or are inconvenient at the very least in order to hit your end goal. So we need to have commitment and a clear goal in order to take those steps. I talked about my experience as a landlord. I've been doing it for 18 years. And why real estate? Just generally speaking, why real estate? And then we compared it to stocks. And then, of course, our guest speaker in the first session was Chris Coyne, how to manage your risk with insurance. Session 2, we talked about 3 different strategies to build your portfolio. So if you're still renting, the first thing is to buy a home. And then if you've been in your home, let's say 5 years, and it's still meeting your needs, but maybe you have some equity in the home, you can think about getting a home equity line of credit, borrow against it, and buy another property as an investment. Or if, let's say, you've outgrown your home, you can convert your current primary into a rental and then go buy a new primary loan or primary home. And so we talked about financing options with Center City Mortgage, and we reviewed the 6 easy steps to building wealth in real estate, which we will take all these steps together. So we'll determine your purchasing power, identify areas and properties that fit your budget, visit and analyze properties, make an offer, go through our inspection contingencies, and then lease out whichever property needs to be leased out, whether it's the new one or the one that you just bought. Okay, session 3, we had my property manager, JG Real Estate, Jared Gruber, was on sharing his top tips for property management and how a property manager protects your assets and the different licenses that you need in order to enforce your lease in Philadelphia. Obviously, if you're not in Philadelphia, you're going to want to go, talk to a local realtor or your municipality to find out what those local laws are. And then I also shared all my top tips from the past 18 years and why I hired JG Real Estate property managers when I'm in the business of real estate, and they do such a great job for me. Last week or 2 weeks ago, we discussed analyzing properties. So when you're buying something to hold, you want to make sure the interest you're earning essentially every year is going to outperform other ways you can invest your money. Otherwise, it's not worth it. So I taught you the cap rate analysis. And then if you wanted to flip a home, so buy an as-is home that needs work, we want to figure out what the after renovated value would be, and then we can backtrack into how much work needs to be done to tell you how much profit you'll make or how much you can pay for the property and still make your profit goal. And then we had Alan Nachimson, an attorney. He talked about buying in an LLC versus your own name, and that topic really is touched by insurance and mortgage as well, because those 2 areas are also affected by how you're owning the property. And then I always recommend clients use an attorney when they're buying new construction and condominiums or in a planned community, because there are hundreds of extra documents that I am not a lawyer, I cannot review them on your behalf, and the attorney will highlight what's in there and also what's not in there based on their experience with these docs that are not always the same across properties. One thing about the new construction is that new construction, there are 2 agreements of sale in Pennsylvania, and the new construction agreement of sale, unlike when you're buying a property from somebody who lives in it, for example, there's no 10-day inspect the property and get your deposit money back if you don't like it. So you want to have an attorney, talk to you about your options there. All right, so tonight's topic, we're talking about the IRS Section 1031 tax-deferred exchanges, also known as the Starker loophole, or 1031 exchanges, or like-kind exchanges, or Starker exchanges. So when they talk about like-kind, it's real estate for real estate, or boat for boat, or art for art. So whenever you sell a property that's been used as an investment, you're going to pay capital gains on whatever you've earned over the years minus what you've paid into the property. So, based on your tax rate, it might be 15% or 20%. So for example, if let's say you have a property, you sold it for $300,000 and you could show that all in you paid $200,000 over the years and the purchase price. So you've gained $100,000. So you could potentially be paying $15,000 on that in taxes. Or if you roll it over into another property that's bigger, mortgage and debt is bigger, or the value in the debt is bigger than the original property, you can defer those taxes. So in essence, rather than taking home $85,000, you're actually going to be reinvesting $100,000 into a more profitable property. Keep in mind that when you're buying a property, you're using a 1031 exchange, you will not have access to this money. This money is going to be sitting in a third-party account for the purchase. So you will need money for inspections and for deposits and appraisals in advance of closing. So keep that in mind. If you did need to take money out of this property, let's say you settled on something tomorrow and you're going to settlement on the new property in a month, you wanted to take, let's say, $15,000 out to cover some other expenses, then you will pay taxes on what's called the boot or booty, which is the money that you've taken out as cash. So you will pay capital gains on that portion only. Then another cool thing is reverse exchanges. So let's say you find the perfect replacement property for a property that you would want to sell. You can actually buy the new property and then use the exchange to sell the old property and defer any gains from the old property based on purchasing the new property. My best understanding of that is you will need to buy the property, you need to have access to funds, which presumably when you do the reverse exchange, you'll basically pay yourself back. But in order to do a reverse exchange, you'll need the funds up front from another source in order to proceed with that. All right, so there's some basic rules that must be followed to the T. Number one, you need to use a qualified exchange accommodation arrangement with a qualified intermediary. Usually this costs about $1,000 or less, and I believe if you just type in 1031exchange.com, you'll find somebody local. And of course, it must be like kind, real estate for real estate. You must identify one or more new properties within 45 days of the settlement of your original property. And they're very specific as to if you name more than 3, let's say, they're expecting you to buy, a big portion of that. So you want to make sure that you're identifying within the rules to your capacity to purchase the next set of properties. And you must acquire one or more of these replacement properties within a total of 180 days. So you have 45 days to identify the properties, and then you must settle on the new properties within 135 days of that. So it's a concurrent period of time, 180 days total. And the purchase price must be equal or greater than in equity or debt to the original property. So you want to keep that in mind as well. Taxes and the tax abatement in Philadelphia. So to understand tax abatements in Philadelphia, it's first important to understand how the taxes work. So taxes are figured out by the assessed values of all the properties in the city times the tax rate. Both can increase at any time unless a tax abatement is in place. The tax abatement is only going to freeze the assessed value. That's important to note. But if the tax rate goes up during your tenure of the tax abatement, your taxes will go up, but not as high. And we'll go through an example so you can see what that looks like. So first, City Council will establish the tax rate, and in a separate entity, the Office of the Property Assessor is going to assess the property taxes. So essentially, the tax rate should be figured out by the city's budget from property taxes divided by the market value of all the properties in the city. Our current tax rate is 1.3998. So if you had a $100,000 property, or every multiple of 100,000, your taxes should be actually 1,400 if you round up a year. So again, with the tax abatement, the assessed value will be frozen over that 10-year period. But if the tax rate goes up, then your taxes will go up modestly. And then there are actually two kinds of tax abatements in the city. One is for new construction, and then there's one that's less commonly used, which is for property renovations. So if, let's say, you buy a property that's $200,000, and then you improve it $100,000, you can actually apply for the abatement on the $100,000 improvement. I always feel a little skeptical about that kind of abatement, because to me it feels like you're almost triggering the city to reassess the property, and you're only freezing the improved value, not the whole equity value. So for example, if the property is now worth $400,000 because of your $100,000 investment in the $200,000 property, that might open you to more taxes on $300,000, a new assessed value of $300,000. So it may not be worth it, but if you're considering that, obviously feel free to talk to the attorney, get his advice, your CPA, we can chat too. So for example, land was purchased and assessed at $50,000, and a new home was built and sold to the buyer for $450,000. So the improvements would be assessed at $400,000 for a total assessed value of $450,000. With the abatement, the annual taxes would be only $700, because it's the tax rate multiplied by the assessed value before the improvements. So $50,000 times, and I'll just say 1.4% for shorthand. So that's $700 a year. Without the abatement, the annual taxes would be the $450,000. So the assessed value before and after, and with the improvements, times the 1.4%, which is $6,300. So you can see that that's a $56,000 savings over a 10-year period, assuming taxes stay at the same tax rate as when you started, which they're not likely to do that. So it's definitely going to be a $56,000 or more advantage or savings. And then, as an example, if the tax rate goes up from 1.5% or 1.4% to 2%, let's say, with the abatement, your taxes will go up to $1,000 a year. So it doesn't go up by much, only by $300 a year, just by that modest 0.5% increase in the tax rate. The house without the abatement would go from $6,300 to $9,000. So that's a $2,700 jump. So as you can see, a modest increase in the tax rate does not greatly affect your taxes, but your taxes will go up if the tax rate goes up, even with a tax abatement. So an abatement is not no taxes, it's just no new taxes on the improved value of the property. And then I alluded to this, the two types of tax abatements in Philadelphia. So because there is a timing requirement for the application and approval of the tax abatements, that's why I always want you to get an attorney when you're buying new construction in Philly, because there's certain things that the developer has to do in terms of being compliant with all their city taxes in order to get the tax abatement. So I don't know how to look that up, but an attorney certainly can look that up for you and help you figure that out. So first of all, the New Construction 10-Year Tax Abatement Act 175 is Ordinance 1456A. So if a builder opens up the permit to do the property on August 1st, they have until essentially October 1st or a few days earlier to apply for their tax abatement. And they should also apply for a 30-month builder's abatement. That way the assessed value is frozen during construction. And then once you go to closing, they're going to give you a certificate to commence the abatement, which as the buyer you'll fill out, and then we recommend just bring it to the city, get it stamped, and that way your tax abatement starts that next calendar year. And of course, like I said, the developer has to be compliant with all of their city owed taxes or they will not get approved. And then if you're doing a major renovation for the 10-year tax abatement, that is Ordinance 961. And essentially the deadline is at the end of the calendar year for the permit issuance. So if I apply for a permit on Christmas, 12/25, I have till 12/31 to apply for my abatement. But if I, pull my permit January 1, I have all the way till December 31st. And presumably I also, as a homeowner or whoever's doing the renovations, needs to be compliant with the taxes. Any kind of tax that's owed to Philadelphia, you have to be compliant in order to get approved for the tax abatement. All right, so I'm going to just wrap up my segment for this evening, just reminding you the next steps or to building wealth using real estate. We do this together. It's analyzing determining your purchasing power, identifying areas and property types that fit your budget. So it might be for rental or it might be for you to live in. And then we'll analyze your current property to see what that would look like as far as a rental goes. We'll visit and analyze properties, make an offer, go through our inspection and other contingencies, and then lease out whichever property needs to be leased out. So if you'd like to figure out what your purchasing power is, just email me at Stacy at phillyliving.com, your primary address, how much you owe, your pity me payment, that is principal, interest, taxes, insurance, and if you pay mortgage insurance, and then any other cash assets you might use for the purchase. So Carl Fisher of Camaplan is going to take over from here, and he's going to share with you how you can use a self-directed IRA to invest in real estate rather than the traditional routes of stocks, bonds, and mutual funds and all those fun things that I don't understand. So I will let Carl take it away.
Hey, I thought your presentation on 1031s was great. One of the things that I like about it is your recapture, your depreciation recapture is also not taxed at that point when it sells. So that's helped me, and I just closed one today. The one thing I don't like about them is most of the time, because of those timing issues that you talked about, the 45 and 185 make you, if you sell high, then you have to buy high.
Yeah.
Or if you sell low, you have to buy low. And that's one of the things I hate about them, but they do save you money.
Yeah, and from my understanding is you really have to pay attention to the timing, because like they say, it's a loophole in the tax code that allows you to do this, so you have to follow it to a T.
Yeah, right. They don't like any extensions, and I've never seen them, and everybody, gets excited if you're there. So I have to start working on mine pretty quick here.
I had one thing, Carl, you just reminded me. There is if you're buying new construction and the builder didn't fill out the proper paperwork or didn't do it in time, there is you can file something that's called a nunc pro tunc, basically the Latin for now for then, saying, hey, but for the fact that we missed this timing deadline, we are complying with your tax abatement application procedure. So there is a way to retroactively get that tax abatement applied, but that would require, the help of an attorney or some savvy buyer going down to City Hall, which is not me. But anyway, you just reminded me, but I'm sure with the IRS that you can't really do that with the 1031. So I will be quiet now and you get.
Nope, you can't. And thanks a lot for having me here. I appreciate it. And I'll let your audience know that you said you were really excited about it when you learned about the self-directed IRA. My mom and dad and their mom and dads were in real estate. So when I found out about it, I was really excited, and I couldn't believe it was real. It took me a year and a half to, investigate it, et cetera. And that was back in the mid 1990s, and they'd already been doing it for 25 years, but only the very rich knew about it. So we'll talk about what it is. I'll show you kind of how it works. It's pretty simple, at least for my part of it. And we'll get into why you never heard about it. And there are special rules and regulations, just like anything with the government. But to me, they're well worth it to understand them and get help figuring them out, because I think it saves tens or hundreds of $1,000s over time, and all the smart people I know are using them. And then I'll talk about the types of retirement accounts and other accounts that can be used like this, and I'll let you know my favorites. So if you don't mind, Stace, can you flip to the next screen?
Yes.
I'm going to keep you working on this tonight because I'm not technically savvy as you are, it appears. So thank you very much for your help. So this next chart up here kind of shows the power of not paying taxes, or what I call making interest on your taxes while the other people are paying taxes on their interest. And this is just a simple example of someone putting in $16,000 and making a 10% return on it. And we assume they were in a 30% tax bracket, and they put it in there for 40 years. It was an example I used 15 years ago. A mother helped her son go into college, start an account like this, and said, what would it be? And we looked at it and figured it out. And then she took it to her financial advisor. So any financial advisor can run these numbers, and it doesn't have to be a self-directed IRA. Whatever you invest in, if you get a 10% return, it'll work like this. But this tells you the power of not paying taxes. And of course, I've done this in a tax-free Roth. So when you take that money out, whenever you're 59 and a half or older, it's all going to be tax-free. So in the one case, you're going to end up 40 years later with 300,000. In the other case, it's $1 million, and that's just on 16,000. So for the young people that are listening, I want you to think about this and try to put as much money away as you have now, because you have the time benefit of the benefit of time with your money over that time, whereas a guy like me at 65 can't, my time, I'm in the fourth quarter at, maybe the start of it, hopefully. So I want the young people to do this, and then I also want the young people to think about if their parents don't do it, they should be talking to their parents about it.
Carl,
Yep.
I wanted to interject something of my personal story here because you reminded me of it, and we talked about it in the first session. So in 2017, I did an analysis of my rental properties that I had at that point for 15 years, and I compared it to my IRA and Roth IRA, which was essentially set up at the same time. And my rental portfolio nearly, what's the word? I eightfold, 800% grew my net worth in real estate, whereas the traditional stock funds, whatever, I don't even know, it was just so pitiful and sad. And when I realized that even just as going from renter to homeowner, and you'd basically be at a net worth advantage of $1.2 million over 30 years with just $1,000 a month, that's when I became super passionate about spreading this word, and I just had faith that it would work one day. And here I am on the other side of it. So, the Chinese proverb says the best time to plant a tree was 20 years ago. The next best time is today. So to Carl's point, those of you who are in your, middle of your second or early second quarter, now is 20 years ago for you, for your 65-year-old self. And you have all these professionals that I've brought to the webinar to support you in this, and I'm sure you have other people in your life supporting you and making good choices. So that's why, especially when you can choose to invest using the Roth IRA and the IRA, and choose to invest it in real estate, that's especially exciting for me because I don't really get stocks. They're so intangible. So this is just, I don't know. Can you tell I'm passionate about it? I'll let you take it away, Carl.
Yeah, no, I'm passionate too, and I'll tell you I'm biased right up front with a couple of things. One is real estate. One of the things that I found very helpful in my family was, adding the fact that you can buy these things tax-free or tax-deferred. And the accounts over on the right-hand side there, the Roth, the health savings account, if you're paying for your own taxes, if you're paying for your own health insurance, you should definitely look at these health savings accounts. As a result, we saved a lot of money. Those monies are making monies. They're in actually notes today, but they're paying all my medical expenses outside of whatever my insurance doesn't pay. And I'm not sure because I just changed insurances on these things. So I want people to look at the different accounts, and I always ask them, how many accounts should you have? You should have as many as you can. Look at them, talk to your CPA, figure out which ones are better for you now. We're talking about somebody in their mid 40s. I'm talking about kids that are just born. You should open up a Coverdell or put them under your health savings accounts. You might want to think about youngsters getting a Roth IRA or a traditional IRA at least. But a Roth IRA, because they're not going to pay any taxes on that, and all the taxes will be, coming out when they're older, tax-free. So think
You can set
about
that
it.
up for your kids?
Say that again.
You can set that up for your kids?
Yes, absolutely. You can set it up for your kids, and you can help your parents out. And there's a lot of other strategies we don't have time to get into today, but maybe we'll do a weekend session, or a day on a weekend where people can attend it, and we'll go over some different strategies that a lot of people like and try to do it. Obviously, I've been doing this for, since 1995, and I'm pretty good at it. And I've seen a lot of things by having my own company and watching what a lot of the other smart people do. And even when Mitt Romney, put his taxes out there, we got a lot of calls about this as well. So it's pretty well known now. A lot of people are using it. Don't be late to the party. Would be what I would suggest at this point in time. And you have your testimonial of how what's worked for you. The other reason you want to use real estate in your account is you have control over it. You probably know it better than stocks and bonds. That's my two main things. I have control over it, and I understand it, and I grew up around it. So that's why I love it. But I also have a cousin who really is good in stocks and bonds and derivatives, and worked for Lehman Brothers at one point in time, and I forget who he works for now. But if you're good in stocks and bonds, then for sure use these accounts for stocks and bonds, and they don't have to be self-directed, because almost any brokerage account will help you with that. But I am gonna, you're gonna see how passionate I am about real estate and tax-free going forward. But yeah, flip to the next slide. I think I'm getting too brought up on this one. So why do I love the Roth IRA? Because basically, if you ask yourself today, where do you think the tax rates are going? Are they going up, or are they going down? Trump said he's going to try to get another tax rate cut in here. I didn't believe he'd get the first one. If he gets another one, great. Maybe you should wait to convert to it. I converted when Obama was in office, and the taxes didn't change that much for me, so I'm glad I did it anyway. But you remove that. When I was in grade school, John Kennedy was president, and the maximum tax rate was 92%. And when Ronald Reagan was president, the maximum tax rate was 28%, and we're looking at 38% to 40% now. So I still think we're relatively low. I do think rates are going up, but if you have a Roth IRA, you don't care, because whatever the tax rate is, you're not paying it. You pay you pay the tax rate today, and what I call that is you pay the tax on the seeds, and you get to reap the crops for free. So that's the number one reason I like self-directed Roth IRAs. You control the IRA, you control the investment, you pick it, you look at it, you can pick your tenants. All of that is up to you. You have a lot of options availability to you too, right? Some people actually will put an option on a piece of property and do it, and sell that option. The tax-free income for life. So now you have income coming into your Roth IRA every month from every tenant that is in a Roth IRA property. So I just love that, because it doesn't even make it to the accountant. He just looks at the statement from the IRA company, and there it is, and he knows that it's a Roth because he filled it in and put it from that aspect. The second thing, or the next one I really like, are the contributions. Once you put a contribution into a Roth, you can take that money out anytime that you want without any penalties and without any taxes, because you've already paid the tax on the money going in. So if you want to take it out the next day, the next month, the next year, 10 years, 15, 20, you keep track of your contributions, you take them out at any time. If you make interest or earnings on that money, you can't take that out, but you can take you can take it out, but you'll be penalized for it. But you can take your contributions out anytime. So basically, any of my family that have savings accounts, I just tell them, put it in a Roth IRA. I don't care if you do anything with it or not. And then it's asset protected, because if you end up with a judgment, the courts can take all the money in your savings account, but they'll leave your Roth IRAs and any IRAs basically for you to retire on. And you can stretch these IRAs. So I can take my IRA, I can bypass my kids, and I can go right to my grandkids and make them the beneficiaries of it, and then they can do it to their grandkids. So now we can have tax-free income as part of my legacy going down, you know, almost 5, 6 generations, depending on where it is. The other complaint I get in my business is there's a lot of people who don't need to take distributions because they've made money outside of there. And if they're in a traditional IRA, the government is your partner in that basically. And when you turn 70 and a half, they tell you have to take the money out and you have to pay the taxes on it. When it's in a Roth, they don't care because they're not getting any money from it. So they don't force you to take those distributions out. But they will force your beneficiaries to take them out. But while you're alive, you don't have to take them out. And as long as you have income, earned income, you can keep contributing to it. So it's just another tool you can use to build your wealth and protect it moving forward.
So
next slide. Yep, go ahead, ask a question.
Yeah, so on behalf of the audience, because I feel like, you know, I'm super skilled in talking real estate. When it comes to talking about this stuff, not so much, right? Because it's not my job. So I want to make sure if I'm clear so that everybody else is clear as well. So if, for example, over your lifetime, you have contributed $100,000 in a Roth IRA, let's say over that time period, you've paid 40% taxes on that. I'm just making a number up. So you'll have paid $40,000 up front. But if you did a regular IRA and you pay taxes in the future, you would have invested, I guess you would have invested the 100,000, or maybe it's more because you didn't pay taxes on it. But essentially, I think I'm confusing myself. But you would pay a percentage at the future tax rate on a much larger amount of money, correct?
Sure. I mean, let's take the example I put up in the front. If you put that $16,000 in there, right? This was a kid who had no tax basis. He made less than $6,000 for the year, so he didn't pay any taxes. And he put this in for the 4 years he was in college. You know, the maximum amount you could put in back then was $4,000. So he didn't pay any taxes on it. But let's just say that you paid, you know, 40% of that. So you paid, you know, or you know, $8,000, $6,000 in taxes, right? So you paid $6,000 back when you were in college, and now you're 59 and a half, and you make that $1 million. You're not pulling that out. But if you pulled it out in a traditional IRA, you'd be paying $400,000 in taxes today.
Right. Yeah,
right?
That's incredible.
So, yeah, I mean, it's definitely there. The wealthy weren't allowed to, you know, they tried to make it hard for the wealthy to use this up until 2010, and the Roth was brought in 1998. But then they made some changes and allowed the wealthy to start converting and using these Roths. They thought they had stop gaps, but they made a loophole for it. So Anyway, I think that's where you're going with it. And I
Yes.
tell people, I couldn't believe it. It sounds too good to be true. And I told everybody, my attorney, my accountant, my banker, financial advisor, and they said, yeah, this sounds too good to be true. And I think somebody ran away with the money. And, you know, so they really scared me for it. And there weren't any books on it back then either, not like the
Yeah.
information today. So it took me a long time to get into it. And then I was trying to look to see what's bad with it. And I mean, still to this day, I haven't found the real cons to doing this. So if you're not sure, do what I did, and I call it toe dipping. Right, when you go to the ocean or the pool, you put your toe in to see what the temperature of the water is. Try a little bit and see how it works. See if it doesn't work exactly how I tell you. And you
So
know,
here's two other, oh, sorry, go ahead.
no, just get your accountant and your advisor and ask them the questions. And by the way, we'll do consults, you know, phone consults and conference calls with these people and just pepper us with the questions. And we'll, you know, we love that because then we make the different advisors love us and start recommending us. So feel free to bring any of your professionals right in and set up a call with us.
Cool. So two other things. So let's say you said, let's say I'm making $1,000 in rent and I'm cash flowing $300 a month. Presumably I'm paying taxes on that if it's not in a self-directed IRA, correct?
Yeah, if it's not in an IRA, you're going to pay taxes on it, you know, but you're going to get some depreciation on the building too, probably. But at some time, if you're buying a property to make money, yes, you're going to be paying taxes on it. It may not be in the first or second year, but trust me, I see the people all the time. Well, can I put it in my IRA now? You know, I'm making a lot more. I didn't know it would blossom into this. And I said, nope, you already bought it. You can't do that. You can't put
So,
your own
and
property into it.
so now let's say it's the properties in the Roth IRA, and maybe I'm getting ahead of us, but what happens to that extra cash flow? Does it get reinvested somehow or goes into my pocket?
Well, it depends on what you want to do with it. You can reinvest it in another property. You can lend money. You can buy discounted notes. You can buy gold or silver. You can invest in a private company. You can lend it to a friend, or you can take it out. You know, either, you know, if you're 59 and a half, or there's 6 other ways you can get it out without paying any taxes on it, depending on your circumstances. And you make that decision. You're in control.
Yeah, very cool. And so, and the last thing I wanted just to make sure I understand correctly is that if, let's say, over my lifetime I've contributed 100,000, but it's worth 400,000, I could take up to $100,000 out without paying taxes because I already paid the taxes on that amount.
Absolutely.
Cool.
But
Yeah.
one of the things I want you to look at is investigate this. Go to camaplan.com on our website. We have a lot of webinars. We'll probably post this up if you allow us to,
Of
Stacy.
course.
And we'll show it. You can call that phone number there and ask for a phone consult, and maybe you'll get one right away, or we'll definitely schedule you one. So there's a lot of good information here. There's a lot of more information that you can get as you go down, and once we understand your circumstances. The audience might be from 20-year-olds to 60, 70, 80-year-olds, and I always get the question, does this make sense for me at this age? And my answer is, I think so.
Yeah.
And people say, well, when should I convert to a Roth IRA? And my answer is, that's up to you. What's your tax rate look like? Get your accountant on, we'll talk about it. What's the investment you're gonna go into? If you're gonna put your money in a CD that makes 2% or a money market that makes 0.5%, really it doesn't matter. I wouldn't say put it in a Roth, because that's not gonna make a difference in your life. There's 2 things I understand, and one is I think you have to be actively engaged in your finances, because nobody watches your money better than you. Even though you don't think you're skilled, I would say learn some skills, pay attention to some of your YouTube presentations, Stace, and The other one is health. You have to be your own health advocate. Not that you don't want to have different doctors and nurses and books out there to help you. Same with finances. Use those people as resources, but have trust in yourself and make your own decisions.
Carl, I don't know if you know this, but I lost over 100 pounds over the past year.
I did not know that, but you look pretty good on the video.
So, so I'll make a plug for what I've done, and it's a lifestyle, and it's not for the faint of heart. It's bright line eating. A bright line is a line that you just don't cross over. So I eat no sugar, no flour, 3 meals a day that are measured, and it is by far the best lifestyle and dietary change I've ever made. So yeah, so
You
bright line,
you took control.
yeah,
You know,
absolutely.
and
Um,
things turn out well when you take control for yourself versus
yeah.
relying on other people, I think.
Yeah, and for that matter, I just hired a Dave Ramsey preferred financial coach to help me, organizing. Like she's actually helped me recoup over $500 of fees that I was paying to my bank. So she's already paid for 2 of her sessions, just by like helping me comb through all of that data. And it feels really good to have your eyes open, take in basically a personal audit, and then take steps forward, for sure.
Yep, I'm right there. Basically, step up to the self-directed IRA. Open up your account, go to our website. There's an online button you can do that with. Um, Fund it. You can fund it from a separate IRA, an old 401k, or you can make contributions to it. Pick an asset you want to buy. Uh, Complete the paperwork. The only difference in your IRA doing it is it's going to say CAMA plan for the benefit of you, Stacy's IRA. And once you sign it and agree to all of it, then the IRA buys it and you sit back and watch the money roll in, and you just, lick your chops and say it's all tax free. And in a year or two, you're going to kind of look at that. And like you did today, Stace, you're going to compare it to what you had in the stock market, and you're going to go, I think I'm going to bet on me for the rest of my life.
Yeah, for sure. And just a couple more fine points. Number one, for all the people who love sweat equity, this is not the place. As I understand it, you cannot clean, you cannot do repairs, you cannot paint, and I'm not sure if it has to be professionally managed, but tell us about that.
Sure. I'm a control freak and I can do a lot of things. I basically graduated as an engineer. I launched rockets for 18 years at Kennedy Space Center. But now I carry a roll of tape in the trunk of my car. So whenever I go look at a property, I tape my hands because I would either tighten a drywall screw or I would pick up a broom and sweep it. And I just said, I've now turned myself into a 15 or $35 an hour guy. I need to be finding properties and do what's going to make me more money and prioritize my time and what I'm good at. So it was easy for me after I saw that, and I lost a couple of deals because I was out painting a place and not answering my phone and going and visiting people. I said, all right, I'm going to do it this way, and I'm not going to put my own sweat equity into it. I'll buy another place, and that place will pay for the extra money that I have to pay professionals. And then I found out that they do that, and a lot of times it was better than what I could do. And I found the guys that would do better than I would do over time. But in an IRA, they do not want you doing work because that's like contributing to your IRA, and it just right, you can put excess contributions in there. And of course, if a lot of people say, well, it's just a little bit. Well, the IRS says we're not letting anybody, because one guy buys a 1-bedroom 1-bath place down in Stone Harbor and then turns it into a 4-bedroom 4-bath place and makes $2 million because he's got his sweat equity into it. And they don't really, right, they don't want that to happen because if everybody was working out of their IRAs, they'd get no tax income at all. So they have it pretty well tight. Can you manage it yourself? The question is, how do you define management? One thing that I really don't like people doing is touching the money. But if you go and you pick up a check and it's made out to Camaplan for the benefit of your IRA and you mail that check in, that's fine. On my rental properties, I do look at all the tenants or I look at the summary sheets on them and the credit scores, etc. So I don't really call it management. I call it, looking over your investments. So that's kind of how it's there. The IRS, you have to put your mind on what's the IRS going to see. The IRS is going to see money. They're going to see documents, etc. And I don't sign those except as read and approved. And I don't touch any of the money. I leave that all up to my administrator.
So, for example, I use JG Real Estate. They find the tenant, they make a recommendation, I review it, I approve it, and basically I pay them 1 month's rent for that. And then repair calls go in directly to them. They receive the rent, they pay me out, and they pay the water bill from the tenant. So, obviously I know what's going on. I approve repairs that are a certain amount, but that to me seems like what the IRS would prefer. Is that a correct assessment?
Yeah, absolutely. If the IRS comes to us, they're going to see that your IRA has a contract with JG, right?
Yeah.
Property management, and they're going to say, all right, this is fine. They're doing it. Stacy isn't paying for it. There's the money coming in. There's the money going back out. If there's an extra repair, then they're probably going to ask the IRA to do it. If it's a water heater, they probably got the money sitting there from the rent. If it's a whole new roof or a kitchen fire or something, they're probably going to need some extra money from the IRA, and then we would pay for that for the repairs. So it's pretty simple once you get into it, and it actually improves your lifestyle. And by doing this with my IRA, I started doing more with my properties that I'd already bought, between 1975 and to the 2000s.
Yeah. So my last question is, let's say you have $10,000 in an IRA that you could convert into a Roth, but you don't have enough to buy a property yet. Do you just have to contribute to it until you have enough to buy it? Can you get a mortgage along with the down payment, or do you need 100% cash?
That is a great question. And so I feel like it was almost a setup, but one of the handouts in tonight's presentation shows you 20 ways that you can take a little bit of money and use it to buy a property. You can, as an example, I this last week, my wife put a contract on a piece of property for, I think it was $520,000. And she put 12,500 down on it, and the owner was taking holding the note back. So basically, holding a $500,000 note or whatever it was minus the 12,500. And I was getting her into right, she was using the 12,500 to get into a new place to rent, and she was going to be using the rent money that came from or she was going to be using my note payment to pay her rent and live on. And I was going to get this house rented and have a positive cash flow for the IRA. But when I was explaining it to the realtor that had the place she was renting, he says, well, what if I buy this note from you? So he says, I'll give you the 12,500 that went into it, plus I'll give you $10,000 for the finder's fee on it. And, my wife said, that's fine, because I really don't want to, be in this area, worrying about this property. So we ended up just taking her IRA of 12,500 and turning it into 22,500, and we actually let them pay it back in a note, so that money's making some interest as well as
Nice.
just sitting there. So there's a lot of those there, and that handout that you have as part of this presentation, you know, everybody is welcome to it. It shows 20 different ways people have done it, and there's more, again, based on what people want to do.
Well, I
And
can't
what,
wait to read that handout. I can't wait to read it. Last thing, really last thing, it's really inexpensive to set this up. Am I wrong?
yeah, I mean, to me, it all depends what people say, but it's $50 to set it up. And we're the only company out there that doesn't charge you a, a fee just to have it. We don't charge until you buy something. We don't want you to rush into a deal. We want you to make sure you do your due diligence. We have too many people that get suckered into bad deals, and we just say, take your time, look at it, make sure everything is good, do your due diligence. Don't worry about having an annual fee charged to you. We won't do it until actually you you know, until you're invested in something making money and it causes us work.
And what's your annual fee? Which this sounds totally fair.
Well, I mean, our annual fee, if you've got, it's between $150 and $275 generally, and we charge $275 for each real estate property that you would buy, and I don't care if that's $100,000 or if it's $1 million. So the percentage is there. I even had some financial advisors call the SEC on us and say, hey, he's got to be selling something over there. He can't be administering these accounts for $275, $1 million account. And, you know, the SEC came in and I said, we're not selling anything. This is what we do. Take a look. And, you know, so the fees are inexpensive to what you're saving on the
Oh, yeah.
taxes. I mean, I'm using 1031s, but I love the IRAs a lot. I don't like the government telling me I got to buy something in 180 days. I was in that situation when a hurricane hit Florida and you couldn't even buy stuff because you couldn't get insurance for it and the banks wouldn't do it. So it was a nightmare at that point in time. So that's when I started trying to do everything I could in the IRAs because, again, you have control and it's on your time.
Love it. So thank you so much, Carl. And I'm looking forward to downloading this handout myself and reading it. And just to wrap up, I am going to turn on my recorder. Can you see me again?
I can.
All right, cool. So
and congratulations on losing the 100 pounds. That's good.
Thank you. Thank you. So yeah, so as per usual, I want to make a plug for Hosts for Hospitals. So most people I know are generous and they might not have all the resources monetarily to give, but they might have an extra bedroom. So if you have an extra bedroom that you can spare once, twice, 3 or 4 times a year, Hosts for Hospitals is a great way to extend Philadelphia hospitality to people visiting like CHOP or Jefferson or Hahnemann or any of the amazing hospitals that we have here. And they have a very easy process. They have an in-home meeting with you to explain the program and to see if it's a right fit for you and vice versa. And you know, then they'll send out the email whenever there's a need. And if you can do it, you can. If you can't, you don't have to. And I've done it before and it was just a great experience. Right now I can't do it because I live in a 1-bedroom, so.
Stacy, how close do you have to be? Just Philly.
Well, let's see, within 45 minutes of Center City.
Well, is that at 5 o'clock or in the morning or 5 in the afternoon?
Well, probably, you know, if they have to go see their doctor in the morning, you know, a lot of times people are here for a week because it's doing extensive treatment. So yeah, please contact them. The care coordinator or the volunteer coordinator, she's actually a realtor too. So it's just such a great organization.
Sounds great. Thanks.
Absolutely. And then obviously this is our last one. Tomorrow I'll be doing a shortened version from 2 to 2:30, and this will be uploaded to my YouTube channel, stacylovesrealestate.com, in a little while. And of course, you're always welcome to ask questions. And then, of course, all the contact information for each of the speakers from weeks 1, 2, 3, 4, and today. You'll notice if you've been here with us, our lender left that company to go work somewhere closer to home. So Amy is the loan officer I recommend at Center City Mortgage. And then, of course, there's my contact information. And then lastly, the books that I always recommend from the Keller Library, Millionaire Real Estate Investor, Hold, and Flip. So we are 3 minutes shy of 8 o'clock. Does anybody have any burning questions? I know I got my questions answered. All right, seeing none, thank you so much, Carl, and thank you everybody for joining us tonight.
Thank you very much, Stacy. I really appreciate the invite and sharing this time with you and your audience.
Yes, absolutely. Thanks. Have a great night.